Hi, and welcome to this Tuesday's talk. And the topic today we're going to talk about a continuation of last week's topic, behavior gap. And today we're going to talk about the behavioral biases that cause this behavior gap. But before that, we'll go into our regular cover up of what happened in the factors space, what happened in the sector space, and the factor all weather space. This is about us. We're a SEBI registered PMS. So this is the factor performance for the week, and it's been a good week last week for uh, generally beaten down stocks. So we saw a revival in the small cap space. Value saw a bit of a bounce back, but the biggest one was by far small caps. Low volatility obviously was the ones which recovered the least because they were also beaten down the least. But on a monthly basis, let's see, and we see that the small caps are still down the most, about 10%. Momentum is down about 9%, and the least hit are the market and low volatility. Let's see the year-to-date picture, and doesn't change much. Small caps and momentum still hit the most, with quality, market, and low volatility being hit the least. Values also in that space down about 6%. So they're all in the region of 5 to 6%, with momentum falling at around 10%, but small cap or size factor being hit the most at about 18%. None of the factors are in an uptrend, as you can see. So the trend still remains down. The dominant trend for the market still remains down across all factors. With that, we move on to the sector performance, and obviously the beaten down names saw a revival, which were mainly in IT and realty. Media saw some bit of revival. Metals and energy saw a comeback, and banks, FMCG, pharma were all flat last week. On a monthly basis, auto, in which we've been seeing an uptrend, is doing okay, up about 2% in this market. Metals and energy have taken a beating this month. Energy, again, because of the news of or the probability of windfall taxes on oil companies. And the metals, again, have taken general hit so far. Year to date, energy is still leading. Autos are still are positive for the year, and FMCG is up about 2%. Just a sec, I think I've forgotten to switch off my video. So let me switch that back on and I'll get back. Yeah. So IT is again, hit the most. Realty is doing okay, and not okay, rather down 16%. FMCG and auto are doing okay, rather. Let's see if I can get the. So we were here at the monthly performance for sectors. So like I was saying, energy, realty, and metals have taken a hit for the month. But year to date, energy still remains the top performer, but it's given back a lot of its gain. If you remember, a month or two ago, it was up almost 25, 26%. It's given back almost half of its gain. So IT again remains the laggard, followed by realty. The three sectors that are up are auto, FMCG, and energy. So out of 11 sectors, only 3 are up and 8 are down. So, not much strength there. With that, let's just a reminder again, you can subscribe to our newsletter at factorinvestor.substack.com, and you'll get all of this to your email once a month. So with that, let's continue with our topic of last week, which was behavior gap. And, I spoke about why investors don't or are not able to harvest the same amount that a fund makes. If a fund makes 9%, investors end up making 5%, and that is because of the timing that investors try to get in and out of the market by timing their inflows and outflows, and that sort of costs them about 4% a year. We did our own calculation for India, and we've also found the gap to be approximately in the same vicinity. Why do these behavior gaps appear? And the answer lies in behavioral biases. There are two behavioral biases identified. One of them identified by Nobel Prize winning psychologists. Let me call them Amos Tversky and Daniel Kahneman, whose book everybody, if not read of, at least has heard of, Thinking Fast and Slow. The first one is the disposition bias, which is that we tend to sell winners too early and we hold on to losers too long. And every one of us has been guilty of this, because we like the warm fuzzy feeling that we get when we sell a stock and we realize a profit. And we all do this kind of mental accounting where, until you've not sold a stock, you've not realized the loss. So if you've not realized the loss, it's still not a loss for you. And there's still hope, or as my friends call it, hopium. That hope plus opium, that hopium that, your stock is going to come back. But more often than not, that does not happen. The second bias is confirmation bias. And again, we are all prey to this. We all have a pre-existing belief, pre-existing position, and we tend to ignore information that contradicts our prior beliefs. And we always try to look for information which confirms our belief. So with these two behavioral biases, we sort of overlay, we ignore, or we try to, overlay our own opinions upon fund managers' opinions again, and that causes that kind of friction or slippage, which causes the behavior gap, and which causes a difference between what the fund returns and what the investor actually earns. So there was a study done in India, I think it was in the year 2012, where Professor Sankar Dev from Indian School of Business, along with a co-author, they did a study on the Indian individual retail investor, and they found that during that sample period of 18 months that they studied, they lost on average of around 8,500 crores. This was based on trading data of almost 25 lakh retail investors, which they got from the NSE, and it was perhaps the largest sample used in a study in behavioral finance. And the paper is called "Are Investors Ever Rational?" So if you search for that paper, you'll get it. We put a link here. And in 2020, Axis did this study for their own investors, and they found that the investor who tended to time his entry in and exit returned on average about 13%. The investor who sipped his way into the fund made on average about 14.5%, and the investor who stayed invested for long made about 18.7%. The data is all there, but it's we are story-driven, narrative-driven creatures. We tend to ignore, like I said, information that we don't want to believe, even if it is true, if it does not fit in with our existing beliefs. So next week we'll probably look at how do we reduce. We can't eliminate behavior gap completely. It happens to professional investors also, but it's not that it does not happen to them. But can this gap be reduced? And we'll try and look at how to reduce this gap next week. This is something we spoke about last week. We ran a model, the factor all weather, and the allocation for June is again a completely in a risk off mode. The allocation is to gold in the factor all weather model. So this week we have the monetary policy tomorrow. So that's going to be interesting, and it's going to be a volatile week. So let's see what happens tomorrow. But with that, uh, that's the end for today's blog and video. So nothing in this video should be construed as investment advice, purely for educational purposes. And please consult an investment advisor before investing. Thank you. You can follow me on Twitter at Anish Daily, or you can follow me on QEDCap, and you can visit our website for more information at qedcap.com. Thank you and have a good week.